Assalamualaikum and hello everyone. My name is Nar Ashikin binti Marsuki and my number metric BB22110519. In this video, we are going to explore an interesting and important topic in finance, which is the difference between Islamic bank financing and conventional bank loan. By the end of this video, we will understand the basic principle behind each type of banking, how they are differ, and what these differences mean for people and businesses. Let's start with a quick definition of both. Islamic banking is a system of banking that based on the principle of Islamic law or Sharia. This system prohibits the charging of interest or riba, and instead they are focusing on profit sharing and risk sharing. For example, let's say you need a loan to start a small business, an Islamic bank will not just lend you money with interest. Instead, they might agree to a profit sharing arrangement where they provide the fund and you share the profit with them. In other hand, conventional banking is what most of us are familiar with. In this system, bank lend money to customer and charge interest on this loan. This interest is the bank profit and it does not depend on the borrower's success or failure in using the loan. For the example, if you take a conventional loan of 10,000 at 5% interest rate, you will pay back the 10,000 plus 5% of that amount as the bank profit, regardless of how well your business does. Let's dive a bit deeper to see how each of these systems actually work. In Islamic finance, banks operate on profit-sharing agreement instead of charging interest. Two common models in Islamic finance are mudarabah and murabbah. Mudarabah is a profit-sharing agreement where the bank provides a capital to an entrepreneur and both parties share the profit. If there is a loss, it's the Rabbul Mal is responsible for any losses, and in this context, the bank also will take the burden. Suppose you want to open a coffee shop but need a fund. In Mudarabah arrangement, the bank might provide the capital and you both agree to share the profit. Let's say 70% to you and 30% to the bank. If the coffee shop succeeds, you both gain, but if it does not, the bank also share in the losses. Secondly, murabbaha. Murabbaha is a cost plus financing mode. For the example, the bank buy an asset to the customer need and then sell it to them at a higher price with payment over a time. No interest in charge, just a markup on the original cost. In this model, Islamic bank take on more of the risk by sharing in both profit and losses. Imagine you want to buy a car. In a murabbaha contract, the Islamic bank buy the car first, then sell it to you at the profit. If the car costs 50,000, the bank might sell it to you for 55,000, allowing you to pay in installment over a time. In contrast, conventional banks operate on debt-based model where they lend money to customer and charge interest on the amount they borrow. The customer is fully responsible for repaying the loan plus interest, regardless of whether they make a profit or loss from the fund. This structure means that the bank has less risk since it's currently a return through interest payment, while the borrower bears most of the risk. Let's say you borrow 50,000 to buy the car. The bank charge 5% interest per year. You will need to pay back 50,000 plus 5% interest each year, regardless of any issue you might have in making this payment. Now, let's talk about some core principles of Islamic banking that make it unique. Firstly, prohibition of riba or interest. Sharia law strictly forbid riba or interest. Islamic bank avoid interest-based transaction by using trade and investment-based model like mudarabah and murabbaha. Secondly, risk and profit sharing. Islamic finance is based on the idea that both risk and reward should be shared. This means that Islamic bank and their customer enter into a partnership where they both benefit if things go well and both bear some responsibility if things does not. Thirdly is ethical investment. Islamic banking also emphasizes investing in socially responsible and ethical businesses. Any investment involving alcohol, gambling, or other industries seen as harmful is not allowed in Sharia compliant bank. Let's quickly review the pros and cons of each type of Islamic banking and conventional banking. Islamic banking pros. Firstly, risk sharing can reduce financial burden on the borrower. Secondly, promote ethical investment and avoid industries seen as harmful. Thirdly, no interest mean no riba, which align with Sharia law for Muslim customer, while the banking cons. Firstly, may have limited product option compared to a conventional bank. Secondly, can be more complex due to Sharia compliance. While the conventional banking pros, firstly, more straightforward and familiar for most customers. Secondly, offer a wider range of product and services, and it's more flexible in terms of financial option and processing time. The conventional banking cons is interest payment can be heavy burden, especially if rates are high and the borrower bear the entire financial risk. In summary, Islamic banking and conventional banking have fundamental difference that make each unique. Islamic banks focus on profit and risk sharing through Sharia compliance, financing model like mudarabah and murabbah. Conventional bank, on the other hand, use interest-based lending where the borrower carry the financial risk. When choosing between these options, it's essential to understand these differences. Thank you for watching. I hope this video has helped you to understand the key differences between Islamic and conventional banking. That's all from me and thank you. Assalamualaikum warahmatullahi wabarakatuh.